Hi, Professor Rex here. In this week's video, I'm going to focus on the simple tech stock portfolio my accounting students and I started in April of 2024, as outlined in red. I'll also talk about two new strategies I'm experimenting with, capital light companies and Wide-Moat stocks, which is a simple way to ensure you're only investing in companies with the strongest competitive advantages. And if you're interested in the dividend growth stock portfolio over here on the far left, I've started a completely free Substack featuring that portfolio to see if I like the Substack platform. If I like it, I might eventually switch my website to it. You can sign up and see which dividend growth stocks we're buying in real time on Mondays. But let's get back to our tech stock portfolio outlined in red on this slide. It's a real-world investment portfolio where I make additional investments on the first trading day of each week. It's by far our most volatile portfolio because it's not diversified since it only invests in one sector. And tech stocks, by their very nature, tend to be very volatile. Also, it's our newest portfolio, so its performance will fluctuate up and down more likely, more so than our other portfolios, which have longer track records. Our tech stock portfolio so far has an annualized return of 4.52%, and it's beating the stock market, the S&P 500. But that's down from a lot where it was, which we'll discuss on the next slide. In next week's video, we'll talk in depth about our dividend stock portfolios that my accounting students and I started back in 2022 and 2023 as outlined in yellow. Like our tech stock portfolio, they are real-world investment portfolios where I make additional investments on the first trading day of each week. So in effect, they are accumulation portfolios mimicking someone in their working years who is consistently adding to their investment portfolios. As a reminder, the portfolios on the right in the light blue outline are portfolios that I started in 2003 when I was in college. These portfolios are more buy and hold portfolios with infrequent trading, so their lack of action might make for boring videos. So you can go online to read more about them if you like less frequent trading, and the website is beatthestockmarket.com. So here's a weekly chart of how our weekly investments into our model portfolio of tech stocks have been growing. It's been a wild ride lately, especially right in this area here. But our tech stock portfolio is beating the S&P 500 so far. When the tariffs were announced on Liberation Day, the tech stock portfolio got hammered brutally, even more so than the S&P 500, but has since started recovering as a 90-day pause was put on the tariffs, and it's looking like some trade deals might be worked out with some other nations. The tech stock portfolio will always be volatile because it only invests in one sector, and like I mentioned before, tech stocks by their very nature tend to be very volatile. Now our Wide-Moat and capital light strategy are both also beating the S&P 500 and with less volatility than our tech stock portfolio. More about those later in the video. Hi, Professor Rex here. My college accounting students love tech stocks and love using what they learn in my accounting classes to pick stocks to invest in. So on April 29th, 2024, I started depositing $12.50 a week into a brokerage account. And we buy 10 different tech stocks each week. We invest only a small amount each week because I wanted to show my students that they do not need much money to start investing. This graph is showing the growth of our tech stock portfolio over time as I invest additional funds each week. There are timestamp links in the description of the video in case you just want to jump to the list of stocks we bought last week or any other section of the video. So here's the usual disclaimer. This presentation is for informational purposes only. It is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. So let's talk about this tech stocks we bought at the beginning of last week. On this slide are our ratings for the top 15 tech stocks as of last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday. Then we purchased the top 10 stocks. Note that all these stocks are higher quality, meaning they must have a quality ranking of B- or better. More on what makes up our quality grade on the next slide. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend growth stocks, because some tech stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, etc. Our highest rated tech stocks last week were Adobe, Applied Materials, Analog Devices, Microsoft, Accenture, Arista Networks, NVIDIA, Taiwan Semi, Salesforce, and ASML. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio. Risk is the first quality component. Tech stocks, by their very nature, tend to be riskier than most other sectors. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. Now, one reason why tech stocks may have been outperforming the market for several decades might be because they tend to require little capital. So as a simplified example, if you want to start a software company, you just need a computer and software knowledge. On the other hand, if you want to start manufacturing cars or jets, you're going to need a lot of buildings, equipment, employees, etc. In other words, a lot of capital, which is very expensive to obtain and maintain. Now, Goldman Sachs recently published a research note that shows that companies that do not require a lot of capital have significantly outperformed companies that employ heavy capital by 544% during the period from 1990 to 2024. The research calculated capital intensity based on three formulas: assets divided by number of employees, assets divided by net income, and capital expenditures divided by net income. After finding this research note, I contacted the authors and discovered we might be able to get even better results because in the study, they ranked and classified companies based on 45 sectors of the ICB taxonomy, not based on individual companies. Not only did they look only at those 45 sectors, they took the sector's median since 1990. So if the sector's capital intensity changed over the years, they ignored that. The authors admitted that sectors that were once capital light can become capital heavy and vice versa. That's why I prefer doing this weekly and recalculating using those three formulas and on an individual company basis. And the authors admitted that within a given sector, one company may be capital light while another is capital heavy. But they ignored that too. I'm assuming they did this to save time because otherwise they'd have to look at each individual company's factors for each month or week and then do this for each and every year in the study, which is a lot of work when you're looking back over 30 years. So it seems their study could have been even better, could have provided even better results if they dug deeper and looked at companies specifically instead of just sectors in general. And we can do this in real time going forward on a weekly basis, and we have been doing this recently. We're looking for individual companies that are capital light, but also high quality. And our capital light rating is based on individual companies, not whole sectors or industries. Before we look at the companies that are both capital light and high quality, let's first look at a list of the S&P 500 companies that are considered capital light, according to the Goldman Sachs study. Once again, the formulas for the Goldman Sachs study were assets divided by number of employees, assets divided by net income, and capital expenditures divided by net income. And since the study covered a 34-year period when growth outperformed value, on this slide, just for fun, I added our valuation column, which in this case is based solely on a growth methodology instead of our usual combination of two methodologies, one being growth and the other being deep value. Now, expect the valuation column to potentially change a lot over the next several weeks as companies start to report their first quarter results and give earnings guidance for the rest of the year. Analysts are already starting to cut their price targets due to tariff concerns, and as of last week, I've started seeing a lot of companies or analysts bringing down their target prices. So these undervalue numbers may be coming in a bit. But on the next slide, I'll show you which ones we think are the best potential investments at this time, as we only want to invest in high quality companies. Again, this just ignores the quality. It's just a rank of the least capital intensive companies in the S&P 500. So on this slide, I have a list of S&P 500 companies that are capital light, high quality, and appear to be undervalued using our growth methodology. So far, the strategy is ahead of the S&P 500, but it's very early in using this strategy. So far, it has provided a 3.12% return with an average holding period of only 50 days. So that's how new it is. That equates to an annual return of 24.78%. Over the same time period, the S&P 500 is basically flat, but that could change really quickly. So for this slide, I started with a list of over 4,300 companies, and the first step was to filter out the companies that were capital intensive based on the three formulas that the authors used in the study. I then filtered out all stocks not in the S&P 500. Then I ranked them based on a combination of our quality grade and their valuation. And on this slide, we have the top 15 companies. The top 10 are Nike, Adobe, Lowe's, Pepsi, Applied Material, Accenture, Hubble, Chipotle, Arista Networks, and MSCI. And I believe I do have investments myself in all of those companies. So now let's talk about the Wide-Moat stock strategy. So this is a strategy I started tinkering with behind the scenes in September of 2023. It's not the most diversified portfolio, so I decided to wait longer to share the results. It's a Wide-Moat stock strategy. So what is a wide moat? What is a moat in general? Well, Morningstar is a financial service that rates stocks and is famous for its moat rating that it assigns to large companies. So what's a moat rating? A moat rating attempts to simply measure the competitive advantages of a company. If a company has no competitive advantages, then it's very easy for another company to enter the industry and take customers away from that company. They call it a moat rating because they liken it to a moat around a castle. If the moat around a castle is wide, then it's hard to storm that castle. If the moat is narrow, then it's a bit easier to attack the castle after you cross the narrow moat. And if there is no moat, then the castle is much easier to attack. So this strategy invests only in the companies with the best competitive advantages. In other words, the widest moats. There are limitations to the moat rating, and I prefer my own quality ranking system that takes much more data into consideration. But the moat rating is kind of a quick, shortcut way to invest only in high-quality stocks. On the next slide, you'll see my ranking for the top 15 companies with wide moats. But first, let's look at the strategy's performance. Like the tech stock portfolio, I've been making weekly investments into this portfolio. I originally had this strategy in a Fidelity portfolio with a few other strategies, but quickly learned that having several strategies, more than two, in the same account makes it a nightmare to track their performance separately. So I sold off those holdings and have since started a Fidelity account dedicated solely to this wide moat strategy. The average investment so far has been held for less than a year and has produced a total return of 20.97%. Using Excel's rate function, that's an annual return of 46.57%. Now, the strategy does not result in a portfolio with as much diversification as most of our other strategies, so the portfolio's performance could fluctuate a lot. And the performance likely won't stay quite that high because stocks historically average a total return of 10% per year. Now, Morningstar offers an ETF that only invests in wide moat stocks. So that ETF is a natural benchmark or comparison for this strategy. Its ticker symbol is MOAT, MOAT. If we'd instead invested in MOAT on the same exact days, we would have received a total return of 10.02% with the same holding period. Using Excel's rate function, that's an annual return of 21.15%. So our wide moat strategy is basically doubling that of the Morningstar ETF so far. So the strategy is also beating the S&P 500 by 18 percentage points on an annualized basis. Now let's look at our list of best wide moat companies as of the close of business on Friday. In other words, the companies with the strongest competitive advantages. These ratings are as of last Friday after the market closed. The valuation methodology uses a growth methodology, not a deep value methodology. Remember, stocks in any of our strategies may appear in the list one week, but not appear in the next week as they might barely miss a screening criteria such as earnings estimates over the next 12 months, which changes frequently. And just because the stock falls out of the ranking one week rarely means that we plan to sell the stock. Sales tend to be rare. So out of the top 15, the top 10 are Arista Networks, Adobe, Nike, NVIDIA, Thermo Fisher, Salesforce, Hubble, Applied Materials, Analog Devices, and Pfizer. Now, one advantage of companies with the best moats is if they pay dividends. They're more likely to increase dividends even during an economic shock when compared to companies with no moat. Now, on this slide, Morningstar shows there are three categories of moats. On top, we have the companies with the wide moats, which are considered the best. This slide shows that during the 3-year COVID period, when supply chains ground to a halt and some companies saw a collapse in sales, about 80% of wide moat companies were able to raise their dividends despite many companies being in financial trouble. Only 18% during the COVID period cut their dividends. Now, for companies with no moat, which is on the bottom of the chart, Only 57% or so were able to raise their dividends, while over 30% were forced to cut their dividends. For that reason, many of our strategies only invest in companies with either a wide or a narrow moat. While our quality ranking for stocks includes moats, it goes much deeper than just one metric. But if you want a simple metric for quality, moats are a good place to start. Of course, this slide only covers a 3-year COVID period. During normal period, dividend cuts are much more rare, and on average, companies increase their dividends 5.5% to 6% per year. So in the comments, let me know if you have any questions, and also let me know what portfolios or investment strategies you'd like to see more of. And finally, here are the places you can reach me: YouTube, obviously, as well as our website, beatthestockmarket.com, LinkedIn, and Twitter. I'll see you again next weekend, likely with a list of dividend stocks we'll have purchased on Monday. See ya!